Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 2. This is Section B1. This is Remembering and Understanding. Understand the leading, coincident, and lagging indicators of economic activity. And that would be things like Consumer Price Index, Producer Price Index, Federal Funds Rate, Bond Yields, and Unemployment. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, one thing I'll say about this video, this is a continuation of the previous video, because this is actually part of the same blueprint topic. In the previous video, we talked about business cycles, and now we're talking about economic indicators, and they're very connected. They're part of the same blueprint, but I wanted to split it up. So in this video, again, we are talking about this, but it's kind of a continuation of the previous video. Now, with that said, if you don't really know much about our strategies, if you don't know much about SuperfastCPA, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam, and again, it's 1 hour, it's free, it's something you don't want to miss. We will save you so much time struggling with the process. So make sure you go check that out. And also, after you watch that, you're going to want to learn more. So make sure you check out becoming a SuperfastCPA Pro member. SuperfastCPA Pro members get access to the full 10-question versions of these 5-question videos. So on YouTube, you're only going to be able to watch 5 questions. But remember, SuperfastCPA Pro members will have access to the full 10-question video on the forum. So if you like this and you like our other products, you can get more of it by becoming a SuperfastCPA Pro member. Now, with all that, let's dive straight into the questions. Okay, here we are at the first question. Which of the following sets of economic indicators consists entirely of leading indicators in business cycles? So which one of these has only leading indicators? So let's walk through this. Option A, stock market performance, producer price index, and building permits. Option B, unemployment rate, federal funds rate, bond yields. Option C, consumer price index, industrial production, retail sales. Or D, personal income, GDP, labor force participation rate. So again, out of these different options, which one of them only contains leading indicators? Now, if you don't really know what a leading indicator is or a lagging indicator or anything about the things we're talking about in this video, that's okay. That's what we are doing in this video. We are using these questions to learn what we're supposed to know about these leading and lagging and coincident indicators. So we're going to go ahead and go straight to the answer to start learning. Okay, here we are at the answer. A, stock market performance, producer price index, and building permits. So all 3 of those are leading indicators. Now let's learn about what leading indicators are and a little bit more about why the things that are listed here are leading indicators. So let's walk through this. Leading indicators are economic metrics that tend to change before the economy as a whole begins to follow a particular trend. These indicators help predict future economic activity and business cycle movements. Some key leading indicators include, and so these are the ones that are listed in option A, stock market performance. The stock market often reflects investor expectations about future economic conditions. Producer Price Index, and that's also called the PPI. The PPI measures the prices received by domestic producers for their goods and services. Since it tracks price changes at the wholesale level before they reach consumers, it can signal future inflation and economic activity. And then building permits. An increase in building permits suggests future growth in construction, employment, and economic expansion. So essentially, just to kind of make sure that that's clear, leading indicators are the things that are happening in the economy that are kind of a predictor. They are happening before the big economic events or economic activities. They are kind of like showing you what's going to happen. So again, these are the things that are happening that are going to inform you, hey, the economy might be about to go down or it might be about to go up. So they can be used to predict the economic activities that are coming up. Now let's talk about the other options and why they're incorrect. Option B includes lagging indicators like the unemployment rate and federal funds rate, which reflect past economic conditions. And we'll talk a little bit more about those kinds of things in the next few questions, so don't worry. Bond yields are a leading indicator. So that was correct, but the mix makes this answer incorrect. So bond yields is another leading indicator. That's something you need to remember, but that wasn't the correct option because the correct option had only leading indicators. Now let's talk about option C. It contains coincident indicators like industrial production and retail sales, which move in sync with the economy. And then finally, option D lists coincident indicators as well, like personal income and GDP, and a labor force metric that does not serve as a predictive economic measure. So the other answers were incorrect because they had coincident or lagging or even things that weren't indicators, whereas option A had only leading indicators. So we learned a lot about leading indicators, what they are, and the things that are considered leading indicators. Now let's go to the next question. Okay, here we are at question 2. And something I always like to point out, now it might not be super helpful in this video just because the questions are all kind of shorter, but I still like to point this out because it's a very good habit to be in. You always want to read the last part of the question first. Now, again, if it's a question that only has 1 or 2 sentences, maybe it's not as helpful, but it's still a good habit to be in because when you read this last part of the sentence, you're going to get good context for what the question is asking you about. Imagine you were on test day you read the last part of the question and you learn, oh, I'm supposed to be dealing with indicators in the economic activities. And then as you're reading through the rest of the question, you immediately are able to start looking for things to show you whether it's leading or lagging or whatever the case is. So again, read the last part of the question first whenever it's possible. It's a very good strategy for test day. Anyway, let's dive into this one. Which of the following indicators would be the most useful in forecasting economic growth or contraction? Let's go up to the top. And remember, we talked about growth and contraction in the previous video, so make sure you watch that as well. An economist is analyzing data to predict future economic trends. So they're wanting to predict. Now, again, which one of these is an indicator that is going to be most useful in trying to predict things? So essentially, which one of these is a leading indicator? Let's walk through the options. Option A, gross domestic product or GDP. Option B, average weekly hours in manufacturing. Option C, consumer price index or the CPI. Or D, average duration of unemployment. So again, which one of these is going to be a leading indicator? It doesn't say that explicitly, but I wanted to just kind of let you know that that's what this question is asking about. Now, based on the first question, you might already be able to know the answer. So pause the video if you need to, think about this, and when you're ready to come back, we'll look at the answer together. All right, here we are at the answer B, average weekly hours in manufacturing. So that's the correct answer. Let's read why. And again, I did point out this is about leading indicators. Leading indicators help predict future economic activity and are useful for forecasting business cycles. One important leading indicator is average weekly hours in manufacturing, as employers typically adjust worker hours before making significant hiring or firing decisions. If weekly hours increase, it often signals future economic expansion, whereas a decrease may indicate an upcoming slowdown. So again, this is something that would show you that the economy is about to change if they start having more hours or less hours. That's why it's a leading indicator. Now let's talk about some more leading indicators. New orders for durable goods. When businesses increase orders for machinery, equipment, and other durable goods, it suggests confidence in future demand. Let's talk about money supply, or M2. An increase in the money supply can indicate future economic growth as more money is available for spending and investment. And then there's changes in interest rates. When central banks raise interest rates, it can signal an upcoming economic slowdown as borrowing becomes more expensive. Conversely, rate cuts may indicate expectations of future economic growth. So again, these are some other leading indicators that you might need to know. These are the things that are going to kind of predict or show you that things are about to change in the economy. Now let's talk about the other options and why they're incorrect. Option A was GDP, and that is a coincident factor or a coincident indicator because it measures current economic activity. Option C was CPI, and that is a lagging indicator since inflation tends to rise or fall after economic shifts have already occurred. And then option D, average duration of unemployment, is also a lagging indicator as the length of unemployment occurs as a result of economic activities. And we're going to dive more into lagging and coincident indicators in just a moment here, so don't worry. But again, these ones were incorrect because they were not leading indicators. So this was another question about leading indicators. Now let's go to the next question. Okay, here we are at question 3. Which of the following sets of economic indicators consists entirely of lagging indicators in business cycles? So very similar to question 1, but now it's asking about lagging, not leading indicators. Let's go through the options. Option A, industrial production, personal income, retail sales. Option B, stock market index, initial jobless claims, new orders for capital goods. Option C, unemployment rate, consumer price index, average duration of unemployment. Or D, bond yields, building permits, and money supply, or of course, M2. Now again, we've talked about this a little bit throughout the previous question, so you might already have a general idea of what the correct answer is. Pause the video, think through this, and when you're ready to come back, we'll look at this together. Okay, here we are at the answer C, unemployment rate, consumer price index, and average duration of unemployment. Those are all lagging indicators. And remember, the correct option had to have only lagging indicators. So let's walk through this. Lagging indicators reflect changes that occur after the economy has already shifted. They confirm long-term trends rather than predict them. The unemployment rate tends to rise after a recession has already started, and remember we talked about recession in the previous video, and decline well after a recovery is underway. Similarly, the consumer price index, or the CPI, is a lagging indicator because inflationary effects take time to materialize. The average duration of unemployment also lags behind economic shifts, as job seekers may remain unemployed even after economic conditions improve. Or essentially, if unemployment is continuing to last for a long time, that is a result of the economy. It's not something that is going to show you what's going to happen in the economy because it already happened. People already have been losing jobs. Now with that, let's talk about some other key lagging indicators. They would include things like corporate profits. Businesses report earnings based on past performance, making this a backward-looking measure of economic health. And next, let's talk about business loan delinquency rates. Defaults on loans typically increase only after businesses have been struggling for some time. So again, after the economy has already been having some activities then you start seeing these lagging indicators like, oh yeah, people are losing money or businesses are going out of business. That's the kind of thing that would be a lagging indicator. And then finally, let's talk about labor cost per unit of output. Rising labor costs per unit often indicate a past trend rather than a predictive signal. So again, we learned about lagging indicators a little bit more in this question. We'd kind of mentioned them in the previous two questions, but now we really got a good look at what lagging indicators are. Now let's go to the next question. Okay, here we are at question 4. Which of the following indicators would provide the most reliable confirmation of an economic downturn after it has already begun? Okay, let's go to the top. A financial analyst is reviewing economic data to confirm that the economy has entered a recession. So again, instead of predicting, you're confirming. I'll just say it again. This is obviously talking about a lagging indicator. So which one of these is going to be a good lagging indicator to be able to look at and see if you've entered a recession? Let's walk through the options. Option A, stock market index. Option B, new orders for durable goods. Option C, consumer confidence index. Or option D, corporate profits after tax. Okay, now we've kind of talked about some of these things in the previous questions, so I would like you to pause the video, think through this, and when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is D, corporate profits after tax. And we kind of talked about that in question 3, actually, so hopefully you got that. Let's talk about the explanation. Lagging indicators confirm economic trends after they have already occurred. Corporate profits after tax are a lagging indicator because businesses report their earnings based on past performance, making this data useful for confirming an economic downturn rather than predicting one. A decline in corporate profits typically occurs after a recession has already started. And now let's talk about a few other lagging indicators that we haven't mentioned yet. Commercial loan delinquency rates. This is pretty similar to one of the things we talked about. As economic conditions worsen, more businesses struggle to meet debt obligations, increasing loan delinquencies. That's, again, pretty much similar to what we talked about before. Now let's talk about inventory to sales ratio. Businesses accumulate excess inventory when demand slows, causing this ratio to rise after economic activity has declined. So that one makes sense. If people are starting to have a big buildup of inventory, that is as a result of some things that are happening in the economy. And so you can look at that as a lagging indicator of, oh yeah, the economy isn't doing so well. Or maybe on the other hand, if people have basically no inventory because they're just selling as much as they possibly can, that would indicate that the economy has been doing good. Now let's talk about the federal funds rate. And this is one of the things that was in the blueprint. The Federal Reserve typically adjusts the federal funds rate in response to economic conditions rather than in anticipation of them. Rate hikes often occur after inflation has already risen, while rate cuts usually follow an economic downturn to stimulate growth, making it a lagging indicator. So again, the government typically isn't going to predictively do these things. They're doing them after things have already happened in the economy and they're trying to help or change things in the economy. Now let's walk through the other options and why they're incorrect. Hopefully, you understand why these are incorrect. Option A, stock market index, is a leading indicator because investors react to expectations about future economic performance before actual changes occur. Option B, new orders for durable goods. We already talked about this. This is a leading indicator because rising or falling orders signal future economic activity. And then finally, option C, consumer confidence index, is a leading indicator. So all 3 of these are leading indicators since shifts in consumer sentiment typically precede changes in spending and economic activity. So that's typically one of the things that happens before other things start changing in the economy, because if people have to start changing how they feel or how they think, and then they start changing how they spend, and that affects the economy, of course. So that's a leading indicator. But we talked about more lagging indicators in this question. Now let's go to the next question. Okay, here we are at question 5. Which of the following economic indicators would be most useful for measuring the current state of the economy in real time? So this is a little bit different. This is a different approach. We haven't really talked about this yet, but it's okay because again, we are using these questions to learn. So let's dive into the options. Option A, industrial production. Option B, building permits. Option C, unemployment rate. Or option D, average duration of unemployment. Okay, so out of these, which one of them do you think is going to help you understand the current state of the economy? Not help you predict and not help you understand what already happened, but help you understand what is happening right now. So again, if you need to, pause the video, think through this, and when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is A, industrial production. Let's go through the explanation. Coincident indicators, so this is the third of the indicators that we've talked about. So we've talked about leading, lagging, and now we're finally talking about coincident indicators. Coincident indicators move in sync with the overall economy, meaning they provide real-time insight into current economic conditions. Industrial production is a key coincident indicator because it reflects the total output of factories, mines, and utilities at a given moment. When industrial production rises, it signals that economic activity is strong. When it declines, it suggests economic weakness. So again, these are the things that are happening and you can kind of use them to understand how the economy is doing right now. Not how the economy is going to be doing or how the economy has been doing, but how the economy is doing right now. Now let's talk about some other coincident indicators. First, there's personal income. Wages and salaries fluctuate with the economy, making them a useful real-time measure of economic conditions. Now let's talk about non-farm payroll employment. And by the way, that is actually something that I have seen. So make sure that you understand that this is actually something you want to pay attention to. Non-farm payroll employment. This tracks the total number of jobs in the economy, moving directly with overall business activity. Now let's talk about real GDP. We talked about GDP in the previous video a little bit. While reported quarterly, so it's not like every day, GDP measures the economy's output in real time, aligning with economic expansions and contractions. So keeping track of GDP real time is also something you can do to have as a coincident indicator. Now let's walk through their options and why they're incorrect. Option B was building permits. And, again, all of these we've talked about in the previous questions, so hopefully you remember these. Option B was building permits. It's a leading indicator because it reflects future construction activity rather than current conditions. Option C, unemployment rate, is a lagging indicator since job losses and recoveries tend to occur after economic shifts. And then option D, average duration of unemployment, is also a lagging indicator as it confirms economic downturns or recoveries only after they have already happened. So unemployment rate, average duration of unemployment, those are lagging indicators, and then the building permits was a leading indicator. That's why, those were the incorrect answers. Now with that, we've gone over a lot in just 5 questions. We've talked about 2 questions about leading indicators, 2 questions about lagging indicators, and a question about coincident indicators. Now, before we do anything else, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2, 3, 4 questions trying to teach you about leading indicators, maybe even specific leading indicators like unemployment claims or lagging indicators like the unemployment rate. Again, you've seen a whole bunch of questions teaching you about these specific things. So you take a moment and write down in your own words the pillar topics that you just learned. And as you're doing this each day, you are building your own personal repository of the most important things you need to know for the exam in your own words. So with that, let's go ahead and look at the pillar topics for this video. Okay, here we are at the pillar topics. Let's go ahead and just dive straight in. First off, leading indicators. Leading indicators change before the economy shifts, helping predict future expansions or recessions. So again, the key word there I think is like predict, the things that are happening that are telling you something is about to happen. And key leading indicators that you should know: producer price index or the PPI, bond yields, initial jobless claims or unemployment claims, market performance, building permits, consumer confidence, and new orders for capital goods. Unemployment can also be a leading indicator when measured by initial jobless claims. And again, that's why we have that there. Just in case you get confused about unemployment, because unemployment is also a lagging indicator if you look at it from a different perspective. So we'll get to that in a second. Now let's talk about lagging indicators. Lagging indicators change after the economy has already shifted, confirming trends rather than predicting them. So again, these are the things that are happening as a reaction to the economy, not something that's predicting what's about to happen in the economy. And let's talk about some of the key lagging indicators you should know: the consumer price index or the CPI, federal funds rate, the unemployment rate and duration, corporate profits, business loan delinquencies, and labor costs per unit of output. So again, that's why I wanted to kind of make sure that this was clear up here. And the key leading indicators is unemployment claims. Like if you're having a lot of new unemployment claims, that can be a leading indicator because you're seeing a trend like, oh, a lot of people are having unemployment. That should be showing something in the economy. Whereas with lagging, with the unemployment rate and the duration, that's where you're seeing things like there's a lot of people unemployed and it's been happening for a long time. And that's as a result of this or this in the economy. So again, you can kind of see the difference there. So I just want to make sure that was clear. Now let's talk about coincident indicators. Coincident indicators move in real time with the economy reflecting its current state. And let's talk about the key coincident indicators you should know: non-farm payroll employment, industrial production, personal income, and that would be excluding transfer payments. That's not something you necessarily need to pay too much attention to, but I wanted to make sure that was there. Retail sales and real GDP. So with all that, again, we've talked about the pillar topics for this video and we've done the first 5 questions. Now remember, because this is the YouTube version of the video, we are only going to do those 5 questions and these pillar topics, and that's it. Now we're going to end the video. But remember, SuperFast CPA Pro members are going to get access to the full 10-question version that I'm about to complete after I complete this. So if you like this and you like our other products, make sure you check out becoming a SuperFast CPA Pro member and you will get access to a lot of great stuff. Now, the easiest way to start learning about those things and getting access to that is actually by first going to superfastcpa.com and signing up for our free 1-hour webinar training. Again, it's free, it's 1 hour, and we will teach you the key ingredients to passing the CPA exam. And after you watch that, you're going to understand and know a lot more about how to become a pro member and so on. So again, check out the webinar, then you can check out becoming a pro member. And with all that, I hope you liked the video. If you did like the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.